Hi, everyone. Thanks for joining us today as we talk about future-proofing your business and what does marketing during a downturn look like? What are some of the things you should and should not be doing? So let me first introduce myself. My name's Angie Dosange. I'm one of the partners here at Marwick Marketing and also the Chief Marketing Officer. Marwick is a digital marketing agency with offices in Canada and the UK. And we specialize in search marketing, social media marketing, website design and development, and anything digital, essentially. I'm joined today by my colleague, Kristin McInnes, who's our division lead for our account director group. And so we're going to explore future-proofing your business today, and hopefully we'll be able to offer you some valuable tips and insights on what you should be considering and perhaps implementing over the next 12 to 18 months. So what we're going to cover off today is, first off, we're going to take a look at our current economic environment. So before we can look too far into the future to see, what we should be doing and where we should be going, we need to have a good understanding of where we're at today. So we'll spend a minute looking at the current economic landscape and how that translates to the future. We'll then dive into strategies for not only marketing during a downturn, but also growing and thriving during a downturn. Kristin will then dive into some insights from the field. She'll talk about the ABCs of marketing during a downturn and provide some practical tips on what you should and should not be doing. So let's have a look at where we're at today. So the big question is, where are we headed? What will the rest of 2022 and 2023 look like? So what we do know is we're entering a transitionary time, post-pandemic world, but we've got some challenges. So based on a BDC economic outlook report that was recently published for 2022, the expected return to normal is not going to be the smooth path that we had perhaps thought it would be, due primarily to things like the increasing inflation rate as well as increasing interest rates. We do still have challenges that business owners were facing for some time now, including supply chain issues, labor challenges, to name a few. But what we do know is that higher interest rates are certainly going to cool luxury spending or exuberant shopping that perhaps we've seen in the past. And also it will impact sectors that are highly connected to and correlated to interest rates. So interest sensitive spending will also see that begin to decline, if not already into 2023. However, based on some favorable market conditions, we are still seeing a relatively strong spending outlook from a consumer point of view for the remainder of 2022 and into the beginning of 2023, primarily fueled by high employment rates, higher than historical wages, and past stimulus that we've seen from COVID-19. So all in all, households remain strong to support economic growth and activity in Canada, which is expected to reach 3.5 by the end of this year. However, all that to say, all indicators are pointing to the fact that we are heading into a recession, unfortunately. But having said that, there are things that you can do, and that's something that we'll be talking about a little bit more in detail. So let's have a look at that. Well, what if we said that now's the time to learn to love recessions? You might say we're crazy, but let's have a look at this for a second. So, a bit like the stock market, where the kind of common knowledge is that when stock price is low, that's when you want to buy. So you want to sell high, buy low. That's very similar to kind of how you can treat recessions when it comes to making business decisions. And we'll explore that a little bit. But let's have a look at some statistics to back this up and kind of paint the landscape and the context around what we actually mean when we say learn to love recessions. Based on a recent survey that was done out of the US by Go Banking Rates, what we found is that there are three main things that business owners do when a recession hits. And so this graph, this pie chart, I should say, shows what those main actions are that business owners take. And not surprisingly, 40% of business owners will cut down on spending and expenditures. 20% will pay down debt, and another 11% will increase the amount of money they put towards their rainy day fund or emergency savings. Paying down debt and putting money towards savings are definitely two very important things to do, and it's good practice to be doing that anytime. However, we see that that's common during times of a downturn. Now, when we look at the 40%, where it shows that business owners are pulling out investments or reducing, cutting operating and marketing costs, this is essentially a knee jerk reaction that we see by most businesses. And now's not the time to do that. So, as I mentioned, pull the example with the stock prices in the stock market, buying low, selling high. Similarly, investing in your marketing activities during a downturn is actually a good thing because your competition is likely withdrawing. And this 40% actually shows us that. So if your competitors make up a big chunk of this 40%, who are cutting down on spending and basically laying low during the recession, not being visible by the target market that you're serving, that creates a major opportunity for you. So what this does is it creates openings for strategic business owners and marketers, so that by continuing to invest and actually double down on areas of growth and marketing activities that are going to deliver high returns, you can actually benefit by getting more bang for your marketing dollar while staying present and top of mind with your target audience, ultimately capturing market share, increasing sales, resulting in an increase in profit. So you can see here why it's actually good to learn to love recessions, because there's marketing opportunities that exist when competitors have to cut back on their marketing efforts. So instead of laying low during this time, businesses can make a greater impact in a less cluttered market. They can also create brand visibility by investing in the right channels and tools. So what do strategic marketers know then? They know that the brand will get more visibility because many companies and competitors will be pausing their marketing efforts. As a result of that, the market share of the business will grow. By employing this strategy, you'll remain visible in the market, and your brand will actually be perceived by the more stable brand by your target market, which will then strengthen your long-term brand credibility as well and build trust. And as a result of all of this, you'll generate more profits for your business, not only in the low economy, but also post-recession. And so how do you do this? It's important, as we know, for business owners to balance efforts to pare costs while also generating short-term sales against investments in long-term brand and business health and growth. So there's 3 effective ways of meeting these goals. First off, streamlining product portfolios. So having a look at your current product mix and your current product and service portfolios to see, are there areas that are perhaps declining? Perhaps there are other products or services that have tremendous potential and you could be doubling down on right now. So having a look at your product mix during these times is an effective way of achieving these goals. Also, looking at ways of improving affordability of your products or services for consumers. Typically, during times of recessions, we see businesses increasing prices, which is fine, and there's a place for that as well. But perhaps there are ways that you can improve affordability by looking at your own processes and systems, looking at your own cost of goods. Maybe there's a way to trim some expense that you can pass on to your customers. And also bolstering trust. And again, this can be done through ongoing communications through your social media channels, as well as staying top of mind. So now's the time to assess these opportunities and refocus your activities and your spending in line with the competitive opportunities that emerge, instead of pulling back and tightening your belts and drawing out of your marketing expenses. Now's also the time where you're going to look to allocating for the long term. So quite often what happens when sales begin to decline, business owners will go into panic mode. And that's when we see things like the pulling out of marketing or reduction in spend is often the first thing that happens. But don't panic. And what we advise our clients and business owners to do is stay the course. Now is not the time to alter a brand's fundamental proposition or positioning. Now is the time to double down on what's working well and perhaps scrap the things that haven't been working too well or perhaps dragging the business down. So what we've seen in past downturns is that companies that were able to actually increase their share of voice by not only maintaining but perhaps increasing their advertising spend were actually more successful in capturing market share from weaker rivals, those competitors that were actually withdrawing and laying low. And not only were they able to capture more market share, but as mentioned previously, they were able to do it at a lower cost than when times were good. And this is because when you think about your competitors pulling out of the market, there's less noise, there's less businesses advertising. So when you think about pay-per-click, for example, when you have fewer competitors bidding for the same keywords, the cost per click is going to go down. So that's just an easy and quick example of how you can actually leverage lower cost advertising during times where others may be pulling out. So on average, increases in marketing spend during recession have actually boosted financial performance throughout the year following a recession as well. And also during a recession or during a downturn, it is wise to contain costs, but failing to support your brand or examine core customers' changing needs and buying patterns can actually jeopardize performance over the long term. So it's time that companies put customer needs under the microscope and look to rebalance the budget. So rather than cutting your spend and containing costs by perhaps jeopardizing your business long term, focus on high return investments. Also, look at the different channels that you're using in your marketing. So we do know that digital marketing, for example, is a great way to get hyper-focused with your advertising. It's a very targetable form of advertising and marketing. And it's also very measurable. So those are the two key things you want to look for when allocating your marketing budget during a downturn. Look to those platforms and channels that are measurable and also highly targetable. This is the kind of the time where we see broadcast media spend typically shrink. So things like print ads, television, radio, unless you have an infinite amount of money to spend, which is probably not the case for most businesses, you want to make sure you're being laser focused with your marketing. Also looking to point of purchase marketing as well, such as promoting price cuts or generating in-store buzz and excitement. So what we have seen from previous recessions is that online advertising in particular, because of its ability to be targeted and relatively inexpensive, and its performance is easily measured, we actually saw in 2008, despite the deepening recession, marketers actually spent 14% more on online ads over the first 3 quarters of 2008 than they did over the same time frame the previous year. So take that into account when you're looking at the different channels that you have been using or perhaps not using, and what you could start to take advantage of now as you gear up to head into perhaps a period of some turbulence. And we can also learn from the past. So what do past recessions tell us? It's based on a Harvard Business Review report. What they found was that during the recessions of the 80s, 90s, and in 2000, of 4,700 companies that were surveyed and studied, 17% of those actually fared particularly poorly. But just as surprising was that 9% of businesses didn't only recover in the few years after the recession, but they actually flourished, outperforming competitors by at least 10% in sales and profit growths. So what was the difference then between these businesses that actually flourished and outperformed competitors and those that did not fare well? So what the difference was that Harvard Business Review was able to identify was the key was in preparation. So rather than switching to survival mode and making deep cuts to spending and reacting defensively, these successful businesses actually made contingency plans. They thought through alternative scenarios, looked at their product portfolios, they assessed different opportunities and took advantage of those opportunities. They doubled down on areas that were strong and thriving or perhaps had room for growth, and they got rid of the areas that were not doing well or perhaps did not have the opportunity or the growth potential. So it's really about taking that time to have a really good look at your business and what makes sense for your business today and going into the future. so that when we do emerge from a recession, you emerge stronger and with a more highly valued business. And now I'll turn it over to Kristin, who's going to share some insights with you from the field.